Hi, everyone. Welcome to our 2023 Market Outlook and 2022 Investment Review. First, kind of want to point out a little bit of a format difference than what we've done in the past. In the past, we've done the live recordings, and one of the feedback, some of what we had there was it's always tough to time everything when people are available. And also, being that it was live, there was a little bit of a reluctance, some people mentioned, to ask questions in a live format. So we're going to try in a recorded format. Obviously, the link has been sent to you so everyone can see it their own time. And then the idea that in the future, we're going to ahead of time ask for your questions. And as always, we always welcome your questions. So one of the things I wanted to touch on before we get into what we see happening for 2023, in the past, I've been asked different questions, what we use for research, what we look to. Here's a little example of all the different, actually not all, this is a fraction of the different outlooks we have access to for 2023. We get research companies like Goldman Sachs, JP Morgan, et cetera, et cetera. Number one go-to, and one of the reasons we transitioned to Canaccord almost 2 years ago, actually it would be 2 years ago, is Morgan Stanley. And I know you can't see this that great, but we can always send you a copy. Their research is absolutely fantastic. Their head's US strategist, Michael Wilson, he has almost been a messiah for investing in 2022 and previously. His the listening of his podcast is through the roof. He's been bang on. What I'm holding up here is a report he put out in October of 2021, well before the market started to fall apart. It's titled Fire and Ice. And what he's warning about is part one, what he calls FIRE, which is central banks raising interest rates to slow down inflation, which of course is going to hurt the economy by design. The other part that he talks about is the kind of the upcoming part two, the ICE. The FIRE, the rising interest rates, I mentioned, designed to slow down the economy. Part two, the ICE, which is what he's talking about right now, lower corporate earnings, and something that as portfolio managers, we have to be aware of. Chris is basically going to take things away, but I wanted to, despite the fact we introduced him almost a year ago, it'd be about 8 months ago, I want to reintroduce Chris. Just want to kind of revisit the fact that Chris and I first met working together at TD 2006. Chris was still young, but younger, bright CFA student at the time. He, of course, completed CFA, but bright CFA student. I talked with Chris a lot. I recognized the knowledge he had right away, and we actually had remained in contact ever since. Chris, I was able to bring Chris over last year after many years at Scotia. Chris has been in the business 18 years. Similar role to myself. Chris is very knowledgeable in investments, financial planning, tax, all these areas. And I'm going to let him take it away.
Perfect. Thank you, Leon. All right. So hopefully all of you can see this. So I've shared my screen. We're just going to do a very quick recap on 2022, as well as provide an outlook for this year. And so in many ways, last year was exceptionally challenging for investors. What was really interesting was the underperformance in both stocks and bonds. As you can see here, it's only happened 3 times in history. And so in many respects, it was a historical year. Something to point out, so we can see here, this is just a list of the returns for all of the major indices. You can see here for the TSX, it was down about 9% last year. The S&P 500 was down over 19.5%. And then just below that, NASDAQ with all the tech companies was down about 33.5%. Something I want to point out that, it was a bad year for stocks. But bonds as well it was very challenging as well. So you can see both the Canadian and US government bond markets on average down 12.9% and then 13.4%. You will note that the TSX did outperform, so it didn't go down as much as the S&P and the NASDAQ. What really helped them to, what really insulated the Canadian markets a little bit better than the US was the exposure to energy specifically. And obviously the NASDAQ being comprised of the technology companies, they got hit the hardest as interest rates were heading up.
Thanks, Chris. So what I want to touch on now is, as Chris said, the 2022 year review. Those of you that recall the Zoom meeting from last year, we started out the year where I talked about the fact, in general, how our preference is to own companies with predictable earnings, high quality. Our preference is to minimize exposure to cyclicals, natural resources, things where the earnings go up and down. Many years with negative earnings, high unpredictability. What is the price of copper going to be? And you can read articles saying it's going to be higher, lower. What is the price of wheat going to be? And then we had to do an about face. Within weeks of doing our Zoom Outlook last year, we had, of course, Russia invade Ukraine, and we had to make major portfolio changes. There's an old expression that's been somewhat, it's been quoted to a number of people, Mark Twain and others, that if the situation changes, I change. What do you do, sir? Situation changed, we made a big change. We reduced our exposure to the US, and in particular technology. We sold off names like Facebook, Meta, whatever you want to call it today, reduced exposure in those areas. We increased our exposure to the companies that previously said we like to avoid because unusual situation calls for unusual changes, for lack of a better word. So we actually put some money into oil and gas. We put some money into agricultural companies. The idea, number one, I was expecting, or we were expecting, that would be one of the larger or better areas of growth, also to protect. It isn't always about what's going to make the maximum amount of money. It's what happens if the price of oil and gasoline skyrocket as they did. So everybody went to the gas pump, saw gasoline over $2 a liter. We owned oil and gas companies. We actually saw thousands of dollars come into our portfolio in increases in these types of companies. So the idea was to protect you from inflation. It's something we had to do, and it is a move that we made.
One thing I also wanted to mention, Leon, were not only did you move the equities around by reducing the exposure to US and moving into CAD, you also significantly reduced equity exposure, period. Right. You also increased the cash weighting, which significantly helped to protect capital for clients.
Good point. Thank you.
Okay, so moving along. Inflation was the primary issue in 2022. It started from supply chain issues resulting from the pandemic. Inflation was made worse when Russia invaded Ukraine, causing both energy and food prices to spike. You can see that the inflation rate in Canada, it peaked in June at 8.1. It has come down since, but you can see over the last couple of months, it's sticking around the high sixes, which is a bit of an area of concern for central bankers in Canada. In the US, they experienced a little bit more severe inflation, which peaked at 9.1, but you can see how it's been coming down at a more steadier rate compared to that of Canada.
Thanks, Chris. And the other part that I just wanted to touch on, it's interesting when we talk about inflation, it is problematic. Everybody has seen something that has just made them say, wow, in the last year, whether it was buying a loaf of bread or you got your bill in a restaurant or tried to buy a used car. There's been some things that are just absolutely shocking. That said, we have high inflation because we have the strongest economy, arguably, in the history of the United States. I can't stress this enough. This is not the biggest problem in the world, that we have an economy that is too strong. If you recall, after 2008, we had pundits everywhere, newsletters being put out, we'll never get the economy going. This is going to make the Depression look like, like nothing, all these different things. So the fact we're sitting here talking about an economy that's too strong, far from the biggest problem. And there's many, many, many countries in the world that would love to be struggling with the problem too strong of an economy. The other thing, as Chris said, inflation is coming down, and it is, again, things are expensive, but it is measurable. Lumber is down 70% from its high. I mentioned gasoline. We saw in Vancouver $2.35 a liter. Today it's around $1.70. Used vehicle index is down around 24%. Inflation is coming down. Again, as Chris showed, still there, but is coming down. The other problem I wanted to talk about, and as Michael Wilson talks about the fire, the central banks raising interest rates. The other problem is that the unemployment rate is what they would call too low. Again, too strong a US economy. And this, again, is not the biggest problem in the world. People having jobs isn't terrible. And one of the complaints the last few years has been, employees are not being properly paid. They're not being paid well enough. They're not being treated well enough, that sort of thing. So now the pendulum has shifted where it's very much the employees, have the ability to choose jobs and, ask for more demands. We're seeing unionizations in places like Starbucks and Amazon. So again, these are issues that central bank is having to deal with, but a low unemployment rate, not terrible. The other thing is, one of the other big reasons we have inflation is there is just too much money in the system. COVID 2020, one of the things I talked about is that I mentioned in March 2020 that to basically keep things afloat, to avert panic, the government would be erring to the side of caution, basically handing out paychecks to people that lost jobs, trying to help businessmen whose businesses were going broke because of COVID. And now there's been some carryover of that. And then going forward, the new problem we have is there's a disconnect between central banks and their mandate to fight inflation, raising interest rates, and then elected officials are countering this as costs are going up and borrowing costs are going up via higher interest rates. Governments are counteracting the Fed by basically handing out money. They're saying, well, things are more expensive because of inflation, so we're going to hand out money. So we saw, for instance, BC, cost of living credits. Alberta announced inflation relief payments. And as I say, they're counteractive because as things become more expensive, costs were supposed to come down. With the government handing out money, costs of goods aren't necessarily going to come down when there's being more money put in the system. The Biden, quote, Inflation Reduction Act, there's some good pieces there potentially trying to move towards green energy, these sorts of things, but it's almost $500 billion of money being pumped into the economy. So it's making inflation stickier than many would like, and it's causing a problem for central banks trying to bring down inflation.
So the primary tool that central banks have to fight inflation is interest rates. And so in Canada, our central bank raised interest rates from 0.25% back earlier this year in January to 4.25 as of the end of December. This was an increase of over 1,700%, the fastest rate increase in order of magnitude in history. So looking ahead for 2023, we expect that inflation will remain a major theme for this year. Inflation will dictate central bank rate decisions and ultimately decide how high interest rates will be going. Although we do expect interest rate volatility to continue, we do expect it will moderate as inflation expectations and as inflation starts to stabilize. With the higher interest rates, coupled with more restrictive monetary and fiscal policy, we expect that these will lead to more modest equity returns over the next couple of years, especially compared to the market returns just prior to the pandemic. And again, just a function of that higher interest rates will have on stock prices. Currently, we think that bonds look attractive and that stocks are starting to look attractive, especially if you have a medium to long-term outlook. So corporate bond yields are near 12-year highs. As you can see, ever since the financial crisis, when interest rates were brought down to zero by the central banks, it was very tough to get a bond that yielded more than 4%. Well, lo and behold, with interest rates on the rise, we are back to about 4.7, 4.8 from the front end to the curve all the way out to about 5 years approximately. And again, this is another chart that just shows that we're seeing interest rates and yields not seen since 2008, since the financial crisis.
Yeah, so it's interesting, as Chris said, attractive yields in bonds. As Chris said, we haven't seen in many, many years. And we're seeing all across the board asset managers talk about purchasing bonds. TD's fixed asset manager called it a generational opportunity. Manager Fidelity's bond fund says Jeff Morris is the best time he's seen in 20 years to get into bonds. So definitely a very, very good or a good time. And I took away the word very, very, definitely a good time. One of the reasons I took away the word very, very good time is there still has to be a little bit of caution exercised. As we talked about earlier, inflation is still sticky. Government leaders are still fighting the central bank policies that are designed to decrease inflation. And there is, first of all, the expectation shorter term rates will move higher. It's debatable whether we're going to move up 1/4 or 0.5% from here on short-term rates. But the long-term rates, the 5, the 10-year bonds, that sort of thing, peaked in a range in and around and over 4%. They're back down towards 3% there. So if inflation remains sticky, there's a bit of a risk that longer-term bond yields could actually rise again, or as they call it, back up. There's also a little bit of a risk that shorter term rates could have to go higher than expected. So one of the things, and Chris is going to talk about that in more detail in a moment, that a person can use to mitigate that risk is buy individual bonds. You lock in a set yield, you can cash them if you need to, or if it's advantageous for you to do so. But if rates move up, whatever the scenario, you hold to maturity, you're going to earn your yield, which is the key there. And that's why I mentioned for safety, that's a good area to look at. The other thing why some of these managers are saying best time to buy bonds in years and generational opportunity, for the first time in many, many years, we can now buy bonds at a discount or below par. Bottom line is you can get a bond that's paying a very little interest or coupon yield, but is going to have a large capital gain because it's trading below par. So for the first time in a long time, we can talk about bonds being tax efficient, attractive overall. All of these different things are all applicable right now.
Especially for corporate and non-registered accounts.
Exactly.
So here we have a list of corporate bonds that we find very attractive here. Notice that they're all of high quality bonds, and with the yields ranging from 4.8 to 4.9. Again, strong, solid issuers. And as Liam pointed out, because of the small or the lower coupons relative to the yield to maturity, a lot of the gains that we're capturing here can actually be taxed as capital gains as opposed to interest income. So moving on to stocks, we find that the equity risk premium suggests that stocks are actually fairly attractive at current levels. That being said, there are a lot of risks out there that we want to pay attention to, but for the most part, valuations are starting to enter the range where we are looking to look for entry points on some names that we follow. This chart will show the same thing, but in a different way. So with the chart here, we show the price to earnings ratio of the S&P 500 going back to 1997. And as you can see, there is room for valuations to kind of improve a little bit further. So we could see a little bit more downside in terms of stock prices. But that being said, from a valuation standpoint, we're still below the historic average, which suggests that it's attractive. We're entering attractive entry points for investors with medium and long-term outlooks. So when it comes to stock picks, as attractive as stocks may appear, given our expectations that we will be experiencing a global recession later this year, we're sticking with high quality names. Specifically, the characteristics that we're looking for are companies that are growing their dividends, have strong economies of scales. They're leaders within their respective industries. They possess unique assets that are very hard to replicate. And most important of all, they have exceptional management teams.
Yeah, so just further to that, as Chris talked about, or has just talked about our investment process and some of what we look at to identify companies. And we're going to be more and more in the future talking little bits about our process, what we do, why things have worked so well. Just in terms of though timing 2023, I know people always kind of, what do you like? What do you expect? What do you see? So to give you a little bit of that, majority, I showed you earlier all the different research reports. A lot of the suggestions are stick with you or to buy utilities. That's simply because they're defensive. And there's nothing wrong with that. We actually like a US telecom stock today. But if we have a big sell-off, that's not the time we're going to be looking to add a utility or defensive stock. That's the time to buy, like Chris identified, these world-class top companies that you always want to own. They're always expensive. We get a sell-off. That's what we're going to be looking to add. These companies that we're not concerned about their earnings in the next 3 months, 6 years. We're going to be looking how much money they're going to be making for us in 3 years, 6 years when they've doubled, tripled in value, growing earnings, as Chris said, growing dividends. That's really what we're looking at there. That's not to say that we're not cognizant of the fact that corporate earnings are going to be lower. We very much expect that costs are higher. Everybody knows, wage demands are high. Cost of fuel, while I mentioned it's come down, it's still high. There's still issues with China emerging from COVID lockdowns. There's still supply chain issues. So costs are high. In a weakening economy, it's going to be harder to pass those costs on to consumers. So we are cognizant of that. We're aware of that, and that's part of the reason we're still sitting in a lot of cash. Cash is earning almost 5% today, and it's almost a certainty that short-term rates are going to go higher. In other words, our cash is going to even earn more. While we expect to see higher returns from our investments in that, it's just plain not terrible to earn a 5% return. That's just not a bad thing on the surface. And then, as I say, the advantage to, or the ability to take advantage of opportunities. Just one area I wanted to kind of flag in terms of another piece we're looking at. There's been a lot of discussion on this. Fidelity put out a great article kind of comparing US, Canada. Just kind of an FYI, where could we have that was a little bit worse than, or a lot worse than expected. Generally speaking, that view is that would be in Canada, and that's simply related to housing and consumer debt. As Fidelity said in the report, average consumer debt in Canada roughly double that of the United States. What I think is the bigger potential issue, though, is that the United States is going into this period of rising interest rates and economic slowdown with the largest percentage in history of their borrowers, house owners who have a mortgage, locked into long-term mortgages. So people that have locked in their mortgage rates for 30 years at near or all-time lowest rates, US has the highest ratio of homeowners in that category. In Canada, we cannot even we can't even lock in a 30-year mortgage term. The norm is 5 years. There is some availability with some of the outlying issuers, 7, 10 years, but you pay a large premium. We cannot get 30 years. And in fact, in Canada, we went into this environment of rising rates, potential recession, with the highest rate of people in floating rate mortgages in history. And we've seen that rate go, roughly from 2 to 5. So that's why identifying still floating could go higher. That's where, if you read a lot of the economic reports, that's where, the kind of the little red flag is sitting. Be a little bit careful, Canada housing, not to mention some measures put in to slow down foreign home buying, that sort of thing. So just want to make you aware of that. The other piece that just want to touch on in terms of valuations, as Chris said, we're starting to see some attractive valuations. Markets, of course, considerably lower than they were. We did some purchasing in October. We had a number of companies hit our trigger buy levels. We are still looking. We have a strategy in place where we're looking at inflation. We're looking at earnings. We're looking at these different pieces. It's all mapped out. We have a number of companies identified that we'd like to buy, but we are waiting for better prices. And I do want to point out that in terms of pricing, one of the things that cannot be discounted is we've moved from an environment of what was called TINA. As Chris said, interest rates were almost zero. So where TINA was, there is no alternative. You didn't own stocks. If you had money in the bank, it earned in essence zero. If you owned bonds, you earned 1 or 2%. In Europe, you may actually have had a negative return or a zero return. So there was no alternative. If you wanted to make money, you had to put your money in stocks. Today, as Chris pointed out, we can get very high quality corporate bonds, almost yields almost 5%. There is an alternative. We're in an area you could call TAMA. There are alternatives today. So stock valuation should naturally be lower when there are opportunities. As Chris mentioned, bonds are a great area to invest money in. That again leads us to want to purchase our stocks at lower valuations, and we are looking for buying opportunities at levels lower than we see today. Perfect. So Chris, I'm going to give you the hard part here and let you touch on a couple administrative items that finish or get the year started, I guess.
Sounds good. Well, that concludes, I guess, the investment side of our chat today. There are some things that I just wanted to quickly highlight as we close up the call. And those were just some administrative items for the year. So your TFSA contribution, the limit has been increased this year to $6,500. And so we're in the process of going through that right now. So for all the clients that have asked us to do it automatically for you, we're in the process of doing that. And I'll be reaching out to those of you who aren't set up on the automatic payment system just to discuss options and how to get that done for this year. Just as another reminder that the RSP contribution for 2022, the deadline is well, we're going to call it February 28th. It's actually March 1st, but there's always people that leave it to the last day. So we're going to call it February 28th, 2023. That's your last day to get your RSP contribution in for 2022. And also, even before then, if you have a spousal loan, that interest payment for 2022 is due by January 30th of this month. So that needs to be done relatively soon. Something else we're very proud of, we have set up a new website. So have a look. You can find it at the petterinvestorgroup.com. We're really open to your thoughts. So please share your thoughts. And if you have any questions about anything that we've said today in our webcast, or if you see something on our website that you want to comment on, please feel free to reach out to us.
Thanks so much, everyone. We look forward to speaking with each of you this year, and we're looking forward to a cautiously optimistic year together.